Hello, everybody. It is Tuesday, September 24th, and I hope you've had a good couple of weeks. I had a good couple of weeks, got away for a week, spent some time with family, had a great week, actually. And now back in and getting back to markets. So, hope everybody's doing well. Hope you're surviving. And let's dig into what's going on with cycles. So, as we've been doing for the past few sessions, going to start out by looking at some of the calls, some of the cycles that we looked at last time and see how they played out. And so let's jump right in. Love to hear from you. If just ping me, let me know where you're listening in from. Let me know who's here. Be great to connect. So, hello, Bruno. Wonderful. All right. Let me make some adjustments on my screen here. And voila. So right out of the gate, last time we talked about cycles in equities. And I highlighted the 4-hour cycle as something that was showing up on my radar, this 227, about 1,000 hours, as a very strong cycle. And it promptly went in exactly the wrong direction. So it doesn't happen that often that the cycles are this wrong, but it does happen sometimes. And want to own it. We talked about, the 1-hour cycle was going up, but we could time that into the 4-hour cycle going down. So I think getting short, we'd have been around here, but it's just been an unbelievably relentless rally since the whisper started happening of a 50 basis point rate cut, and then the 50 basis point rate cut plus additional dovishness from the Federal Reserve started seeping through the media and then through the reserve officials. And that happens sometimes. And those events, especially central bank type events, can temporarily override cycles. So thankfully, we shouldn't have been caught completely flat-footed. We noted last time that there was a lot of contradictions in the cycles, kind of bullish on the 1-hour, bearish on the 4-hour, bullish on the daily, right? And here's what the daily looked like when we last were together right here 2 weeks ago on September the 10th. So the daily had given a buy signal. Just looking at the E-mini S&P here, it was the same on the NASDAQ. I can make this even bigger if you want, but here we are. We were right here on the 10th, got that CRSI buy trigger on the 11th, and it has been off to the races. Not exactly the bearish September that seasonality suggested we've been getting. But, we said last time, look, the dailies are bullish. It's the same on the NASDAQ. There's buy signals with the CRSIs. The trends are up, right? They've been up for quite a while now. We're at the topping stage on the weekly cycles, but topping can take a while. So it's up, still up on the daily cycle. And we have to take that, we have to keep that we have to work with that. So that's where we're at. That's what we talked about last session a couple weeks ago. And today I want to revisit stocks. And I also want to look at bonds, which we last looked together on July the 9th. So that was a couple months ago. And then talk about how a trade involving stocks and bonds could work together, and what is a good trade that we can find using stocks and bonds. So that's what we're going to work on today. Of course, this is trading market cycles, right? So we get into the nuts and bolts of trading a little bit more, in addition to adding the cycles to our toolbox, right? We don't trade cycles by themselves. Everybody's got their own trading strategies. I'm here to educate you on how I use cycles and how I trade. So let's go. Before we jump into bonds, though, let me just briefly highlight our natural gas call, which happened back on July the 23rd is when we talked about natural gas. Went through a little pain, a little retest, and as I suspected, we have an explosive move going on in natural gas before, the end of the fall. And when natural gas moves like this, what is this, from August 28th at $1.80 to September 23rd at $2.60, 80 cents, that's 40% move in a month, right? Wanted to be ahead of this, and I think we've been ahead of it. So hopefully that paid off a little bit. Is getting, a little long in the tooth, but momentum is still heading straight up. And if we update this, you can still see a pretty clear signal here from the 72 day cycle in natural gas, heading straight up. Definitely going to get some right translation here on this one, but do note that the daily cycle is topping. All right, let's move on to bonds. So wanted to start here for just a minute. This is, so I know a little complicated. What do we have here? This is the yield curve. All right. So along the bottom here, we have different lengths of maturities and treasuries. Here's the 2-year. Here's the 3-year, 5, 10s, 20s. Okay. And this red line is where yields were on July the 9th when we last revisited bonds. So 2-year, which we highlighted as the most attractive of the bonds back on July the 9th, were at 4.62 back then. And today they are at 3.57. So that's 105 basis points up or down in yields, right? Which means 2-year bonds have gone up dramatically, and they've gone up the most. The gap between today, September 23rd, and July the 9th is the biggest in 2 years, bigger than the gap in 5 years, 10 years, and 20 years. And we're starting to see, the flattening or the uninverting of the yield curve, right? So now we have 10 years at 3.75 above 2 years at 3.57. Back in July, that wasn't the case. The 2 years were at 4.62 and the 10 years were at 4.3. So the yield curve is uninverting. That's a big deal. Bonds have been going up across the board, right? Yields have been going down. Question is, has that move run its course, or does it have further to go? And where on the the bond spectrum do we want to focus? So jumping back to what we were looking at back on July the 9th, this was the weekly cycle in 2-year Treasury note futures. Straight out of Yahoo Finance, ZT equals F dash W colon YFI. And we see this 304 week cycle. That is a long time. So, the last bottom was in 2018, now bottom in 2024. And pretty clear that this cycle has room to run and momentum heading up. And certainly since July the 9th, it's been solidly up. If we update this, incorporate the latest data here, and I'll try to keep an eye on comments as I go, but mostly be taking comments at the end, but try to make it easy for me to keep an eye on things over here. All right, so again, this longer term cycle here. Still plenty of room to run out into 2026. Why isn't my AI ranking showing up? Let's go here. I think it's under scanner actually. Update. Okay, and then number 2 cycle here at 228. Also bullish. Okay, so weekly cycles in 2-year treasury bonds. Bullish, bullish, bullish. Daily cycles, on the other hand, which, this is trading market cycles, so we're usually not looking at weekly cycles other than for some orientation. Again, here's where we were on July the 9th when we looked at this call, and it's been pretty relentlessly up since then. But let's get the CRSI turned on here. So still pretty darn bullish with momentum going up and some room left to run in the cycle. If I make this full screen here, topping October 10th, momentum still up. Let's incorporate the latest data in here. And just 1 second while I get okay. What was this? About 181. So still this cycle right here. So I think this is great that we've had this run. But we are nearing the top of the daily cycle in treasury bonds. So as far as bonds are concerned, 2-year treasuries, not bonds, sorry, 2-year notes. The daily cycle is nearing the top. It's in the topping zone already. Has not given a sell signal. Weekly cycles, still plenty of room to run. So that's where we are in terms of the bigger picture of bonds, the easy money of this long trade in bonds that we picked back on July the 9th, I think has been made. Question is, are we topping? So in order to explore that question, let's go down to the 2-hour data in bonds. The 2-hour data has a pretty strong cycle at right here around this 231. It can change a little bit, but there's that one, and then there's also this 76 period cycle, which has been coming on more of late, but still room to run on 2 years on the 2-hour data for the next week or so. So I'd say over the next week, still have support from the daily, support from the weekly, and the 2-hour cycles are bullish. And, momentum has worn off, right? And I wouldn't say momentum is strong right now, but it's definitely not at its low and starting to look like it's turning up. Anything else? Let's see that we can look at for more support here. Maybe down at the 15-minute on treasuries, we can take a look. It's 197, 146, also bullish. So I think that in the 2-year notes, again, easy money probably off the table, but still some room in a topping process, and the 2-hour trade looks bullish to me. All right, now let's talk about stocks. I'm just going to use the E-mini S&P, right? 2-year treasuries, E-mini S&P, stocks and bonds, that's it. I know there's a bigger picture out there, but that's what we're working with today to set up a trade. So we've looked at this many times. The 180-week cycle in stocks still got some room left, even into 2025. New all-time highs. No bearishness here on the weekly cycle. Not yet. Daily cycles. We were just looking at this from 2 weeks ago, reviewing our calls. This is just the cash S&P. And again, here we are. New all-time highs. Room to run in this cycle until mid-October on the dailies. Yes, negative momentum divergence here for sure, but momentum still heading up. Just an opportunity this morning for the market to reject these highs. And with the consumer confidence coming in below expectations, considerably below expectations, but the market so far, at least as I recall, unless things have reversed, tested some lows and are right back up at the highs. So things are bullish, okay? Momentum is on the side of higher prices. If we look at the futures, same story. Let me just jump over now before we go to the shorter term timeframes on equities. And I just want to go down here to the trends table. Okay. Here's the trends on the S&P 500. Okay. Shorter term trends of 20 minutes, 2-hour trends, daily trends. Green, 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 green. 12.27 total. It's about as high as it gets, except for gold, right? And we talked about gold. We can just peek at gold for a second, but we looked at gold a couple months ago or a month ago, said, I don't think the bull market's quite over. And indeed, we've gotten new all-time highs in gold. So again, I think the easy money's off the table, but gold and silver still moving up. All right, and then 2-year T-notes, okay? A little bit of weakness in the trends on the shorter time frames, but still pretty darn solid. Total score 7.4. This is not a bear market in bonds yet. All right, so trend-wise, cycle-wise, we got bullish bonds, we got bullish stocks. All right, here's the 2-hour data on the E-mini S&P. And just peeking over here at my other screen for a minute. Yeah, so it's this number one cycle here. This is 144. Make sure we're current. All right, so this cycle is got a little down ahead of it, maybe through today, September 26th, right? 24th, 26th. So wouldn't be surprised to see a little pullback here, and with an opportunity to get long, maybe a partial long position now with an add on a pullback. But momentum is kind of skimming along the top here, hasn't broken down. The cycle is down, but that has just stopped the upward thrust at the moment. So on the 2-hour, I can't say that this is an exciting bearish, short trade on equities, given the bullishness of trends, given the daily and weekly bullishness. I'm looking for a bullish opportunity. I might go down to the hour cycle, see what's going on there. This longer term cycle has been the dominant cycle, maybe another day, right? So I think a long trade in the E-mini S&P and a long trade in the 2-year Treasury notes are what we want to look at for setting up a combined trade of stocks and bonds. So I'm going to get into the particulars of the trade here in just a minute. Excuse me. But I just want to stop for a minute and see if there are any questions. All right. Oops. All right. So everybody tracking what I've covered so far? I see a question about the Russell. It's a good question. I am keeping an eye on the Russell. I think the Russell is a tell, especially when bonds, 2-year Treasuries are rising. If you don't see the Russell rising too, because, going into 2-year Treasuries could be a flight to safety, but it could also be, lower interest rates anticipated in the economy. And that should be good for small cap stocks, right? So good idea to take a peek at the Russell, and we can definitely do that. All right. Let's see. Mark, do you currently tie in the cycle scanner with seasonal trades from Jake Seasonal Trader for any trades? I do look at Seasonal Trader, and I work with Jake on Seasonal Trader. I'm not focusing on seasonal trades exactly right now, more kind of seasonal trends. So that's how I use Seasonal Trader along with the cycles work here. So thanks for the question, Mark. All right, so let's keep going. I know this is a lot, but we can do it. All right, so what we've got here, two-hour in Treasuries around 232. Got a good, say, week-long trade to the upside. This is the hourly in the S&P. Maybe a day of weakness or two. And this is the 2-hour in the S&P. Oops. Wrong cycle. We're looking at this one. Again, maybe a couple of days of weakness. So some of this momentum would be great to work off. But I'd say in the next couple of days into a correction, be a good opportunity to go long. So now I want to get in to looking at how we would go about setting up this trade. I'm using the 2-hour data here, okay? I'm just starting with looking at the two trades separately. So long one E-mini S&P futures contract here, okay? And then in portfolio B, we've got long 8 2-year treasuries. And I'll show you why I picked those numbers in just a minute here. So let me have that recompute. All right. So right away, I've set a risk exposure target of about $5,000 for each trade. So one E-mini contract is on a 2-hour bar, okay, is about $5,000 of exposure, which means if things went against me, you know, for every 2-hour bar for 10 periods in a row, I'd be down about $5,000. And 8 contracts in the 2-year treasuries give me about the same amount of exposure. Now, both of these have no diversification. Okay, they have 0% diversification because it's just one asset in the portfolio, right? So just looking at these separately, we see what happens when there's just, you know, $5,000 of each one separately of exposure. That's not the amount of money we put in, right? I don't know what the margin is on that. On the S&P, it's probably $15,000. It's probably comparable on treasuries. So maybe this is a $30,000 margin cost. All right. So now let's look at what happens when we combine the two trades together. So I know there's a lot going on this page. Sorry about that. Try not to make it too distracting. So we're just going to say yes to the long 8 treasuries in portfolio A and yes to the long 1 S&P and portfolio B. So these are going to be identical right now. That's fine. All right. So when I combine them together, the two trades, which are pretty uncorrelated, okay, my risk exposure of the two combined trades is $7,500. So that's different than the $10,000. This is a discounted exposure model. So we can see here in the correlation matrix, I can make this a little bigger. You know, the E-mini S&P 500 here, this is the row here, and the treasuries are over here, are a little more negatively correlated than uncorrelated right now on the 2-hour data. They're pretty uncorrelated on the daily data, a little negatively correlated on the 2-hour data right now. But they're not highly correlated. So that's why we get the discount on exposure. So I'm looking at a trade, you know, about a week long in long E-mini S&P, especially on a pullback, plus long 2-year treasury notes. When I combine those two trades together, I get a 25% discount on my exposure. Instead of $10,000 of exposure, $7,500 of exposure. So last little step that we might consider is looking for a third component of this trade to see if we can get some even better discount on exposure. So I've started setting up here, like crude oil right here looks interesting to me. To the long side, okay? The cycles on crude are turning up. There's a 1 hour cycle here. We'll take a look at that in just a minute. I think the long side in crude could be a nice add to this little portfolio of trades with a 1 unit to give us about $5,000 of exposure. So let's go take a quick look at crude oil. On the hourly data, got this big cycle here jumping out. Don't think that's the one we were looking for. So let me just check here on crude hourly data, 271. Looked like it was bottoming. All right, well, not seeing it here quite yet. So gonna just stick with stocks and bonds right now and have to dig into the crude opportunity a little more to see if indeed it does look like there's a bottoming cycle opportunity. But let me just show one last thing here. If I go back to portfolio B and I add in one long crude contract, I think I did it in portfolio A. And then when we compare them, okay, portfolio A now has 40% diversification, $15,000 of exposure is only $9,100, right? So that exposure only went up about $1,600 from the $7,500 of exposure. So that's a pretty nice 1, 2, 3 punch with long E-mini, 1 contract, long treasury bonds, 8 contracts, and long crude oil, 1 contract. That's how it works. That's how I do it. And but the trade that I want to stick with for the purposes of this today is the 1 E-mini and the 8 treasuries. And we'll see how they do through the course of the week and take a look at it together next time. All right. So let me get back over here. And I forgot, we'll take a look at the Russell, but let me see if there's other questions. So equal weight in USD, the S&P, and a 2-year treasury. It's actually equal exposure. So it's not equal weight. It's not the same amount of dollars in each one. It's the same amount of exposure, the same amount of risk. Okay. Very important point. It's like, how much do you lose or win if things go for you, or if things go against you 10 periods in a row? So exposure is different than the dollar amount. Okay, it's the dollar amount times the volatility. DR, I really like how you show us all the personal tools you're developing as you go. Thanks, DR. Getting really close on RiskSmith. I had hoped to show it to you today and actually use risksmith.com for this today, so you can start to do more of this yourself. Cautiously optimistic on next week. Development is hard. If I understand this, is 5K 2-year treasury and 5K in S&P. So no, it's not. It's 5K of exposure. So yeah, I think 1 S&P E-mini futures is about $15,000 of margin. So we are using futures here. But it's not $5,000 of money. Okay. It's $5,000 of risk. And 90% of the risk is in the S&P. No, they're actually equal risk. Okay. So the same amount of risk in both. It's a balanced risk. That's why we use exposure. Could you explain further how the risk reduction occurs? Yes. So it's basically, you've got an average of two different lines, right? One zigging and zagging, hopefully up and to the right. The other zagging and zigging up and to the right. And when you average those two together, you get a smoother average. Okay. So you're looking for things that are uncorrelated, that when you put them together, you get less volatility because it's the average of those combined elements. So that's the big idea. This is diversification via portfolio construction, though I do not know the mathematics exactly. So, this goes back to modern portfolio theory, which was a good thing. I know that there's skepticism about it today, but it's essential to how markets work. Correlation is something that is, Ray Dalio calls it the holy grail portfolio, 15 to 20 good uncorrelated return streams. I'm bringing this idea of correlation, exposure, diversification to trading. How do we incorporate that into shorter term timeframes to make sure, when we're making a trade, we're getting the best discount on our exposure? So more to come on this. Wanted to get this ball rolling because it's a key part of trading market cycles, and getting really close on being able to offer these tools to you for free. All right. So we said we would look at the Russell. Good idea. Let's go back and take a quick look at what's going on with the Russell. So start with hourly data on the Russell. And actually, let's look at the trends on the Russell. So the Russell here, some weakening at the very bottom of the trends, but still a lot of green there. Not as strong as the NASDAQ and the E-mini, but not in the red. Okay. If we look at what's going on with the Russell on an hourly chart, not a lot of cycles really clear on the hourly data on the Russell. When we look at the 2-hour data, we do start to see some more persistent cycles, especially, which one's this? This is around, yeah, right below 150. So 139. Okay. This is on the 2-hour data. Also have this longer term cycle here. Looks a little more iffy. Momentum is weaker than it's been in the E-mini and the Dow. And the NASDAQ. So not a great sign. And if we go look at the daily data, definitely have This is the 86-day cycle. So it's one, around that 80-day area that we see a lot. Just, the cycles in the Russell just aren't as strong as they are in the E-mini and the Dow. But overall, I'd say I'm not really crazy about how the Russell has been behaving, especially given the reduction in short-term interest rates. The Russell should be taking off like a rocket ship, and it's not. So I'd say that gives some pause to the overall thesis about bullish equities. But still, over the next week, we got bullish equities, daily and weekly, bullish trends. We got bullish treasuries, daily and weekly, bullish trends. We got a clear bullish cycle in the 2-hour on treasuries and an imminently bullish cycle in the 2-hour on equities. And then starting to learn how we take equal risk, on multiple trades to overall get a discount on our exposure. More on that to come. All right. So thank you, everybody. We'll see if there's any final questions that I haven't covered yet today. And hope to see you again next week, and hope to be able to put some of these exposure diversification tools in your hands. All right. Thanks so much, everybody. We are the Foundation for the Study of Cycles. We are a 501c3, not-for-profit. Exciting things happening at the Foundation right now. If you're not a member, please join us. And if you aren't using our intraday Cycle Analyst Pro, consider upgrading. Really, I'm telling you, a lot going on behind the scenes. The Foundation is really building up ahead of steam, and I'm very grateful for all your support and all of our supporters. Thank you. Have a great week. See you next week.